Cool. So welcome everyone. Good morning, good afternoon, good evening, wherever you are. So this is the second lecture in the Quant University Fall School. And today we are pleased to have Sarah Biller from Vantage Ventures and also from the Fintech Sandbox, and also D.Shahrawat, who is an investment banker at Rosenblatt Securities. And we have chosen today, which is going to be the first day of the next 4 years, I guess. And we wanted to see how we're going to be looking at fintech, and especially with post-COVID scenarios and how things are going to go between now and the next few years with investment opportunities, the possible opportunities for startups, the opportunities for large corporations to think about the payment landscape, blockchain, looking at investment technologies, looking at cybersecurity and other means, and also how does the whole ecosystem change over the next few years. So what I'm going to do now is briefly tell a little bit about what we have been doing in the Quant University Summer School and the Fall School, and I'm going to pass the baton on to Dee. So let me share my screen. So this is the Fall School. So we actually are running 3 courses. One is a data science course, primarily for people who are interested in learning Python and implementing data science applications. The second one is called as an AI machine learning course for financial professionals. And the third one is a model risk and a governance class. So all these 3 courses are offered in partnership with Premier. And this time we are also offering a fintech bootcamp. We call it the 8 facets of fintech. So this program was conceived a few years ago when I was teaching a course on the same topic, but this course has become an elective at Northeastern University, where I teach in the business school, primarily in spring. But we've also done mini versions of this at the Boston Fintech Week last year in fall, and Dee was gracious enough to present his research at the Boston Fintech Week last year, and he's going to provide a mini version of it today, I guess, in today's session. And it's always a pleasure to kind of look at what's actually happening in the world. And we have invited speakers from different disciplines, and we had a class on synthetic data generation by Gautier Marty last week. And this week we're going to have a course on fintech in the post-COVID age. Next week we're going to have Dan Libu from Lightbuild Capital. He has written a book called the AI Book, and he's based in Singapore. And he's going to be presenting a talk on the ethical use of AI in financial markets. And from there, Stephen Jansen, who is the author of the book Algorithmic Trading, will be doing a talk on synthetic data generation in finance. And then we have a talk on alternative data and the API jungle. And a good friend of mine, Jakob Weinstock, who was the CTO at Arden and also another large asset management company in New York. So he's going to be joining us. And we are also bringing in a couple more speakers on this topic. And then week 6, we just had a brief discussion yesterday with Valeria Sotovic from PwC, Reed Blackman from Virtue Consultants, and Junwoo, who's a Forbes reporter on various technologies. So we're going to have a discussion on responsible AI in action. So we have a packed agenda for the next few weeks. So if you're interested in learning more about the Fall School and also the lectures in the Fall School, please register at qfallschool.splashthat.com, and we will be sending you more information. So without further ado, I would like you to join in for the next 45 minutes to an hour to hear about what does fintech mean in the post-COVID age. A brief introduction to our eminent speakers. Dee is a director in Rosenblatt's fintech investment banking practice on Wall Street. His group provides leading fintech strategic advice, pursue M&A, and raise funds for VCs, PEs, and other institutional investors. He has 20-plus year track record with various financial institutions, and he has written tons and tons of reports. I love reading your research, Dee. I've been reading it for the past 20 years now. He's also a fellow Northeastern alum, and also gives a lot of time to educational causes, and I do appreciate he joining us in today's session. The one thing is he's also a CFA charter holder since 2007, and he also does a lot of presentations for the CFA Institute at various chapters. And another good friend of mine, Sarah Biller. Sarah and I, we have known each other for close to a decade now. She is one of the most kindest person I've known in terms of giving her time, her advice, and also making time for building the community. And her approach to bringing the community together has resulted in one of the forefront in terms of the fintech areas, which is the fintech sandbox. And she has given her time and effort in just bringing all the ecosystem players, the investors, the large corporations, and helping small startups to basically get connected with all these other organizations in terms of making sure that whatever they've been building are actually scalable and usable in the enterprise. And beyond that, she has, I don't know where she finds this time, but she gave away her secret early on by saying she's not sleeping, and she did not sleep at all last night. So she does a lot of education with Brandeis and Boston Youth College and MIT. And she was also at State Street leading innovation ventures there. And she's also right now working with Vantage Ventures. And I would love to hear more about your Hyperloop project and how you've been able to bring it into fruition. Anytime I have a conversation with Sarah, I learn so much more. And thank you so much for graciously presenting at today's event, Sarah. Without further ado, I will hand over the stage to Dee. And Dee, I think you should be able to share your screen now. If you're not able to, I will be able to try and help you. But would you be able to try sharing your screen?
Sure. Actually, it says that it says the host is disabled sharing. So try that again.
Let me see if I can. Okay, so could you try now, please?
Sure. How's that?
Perfect. So we can see your screen now.
Great. Let me just switch it to full mode. Terrific. Well, thanks, Sri and Sarah. What a pleasure to be back on the air with both of you, and particularly in these kind of unprecedented times. So since we've been all busy with our event over the last 24 hours, why don't we talk about that first? And of course, anything that I say, I may have to change completely in 48 hours. So, nothing that I do or say can be used against me in a court of law. But, if you just look at the framework of what the implication of the election might be, whether it's another 4 years of the Trump administration or a switch to the Biden administration, there are a couple of factors that, we sort of are universal. So the first set of factors are what the indirect implications of the election might be on the fintech landscape. And I won't spend more than 2 minutes on this. We'll spend about 5-7 minutes on the next slide, which are direct implications for the fintech marketplace. So the indirect implications are obviously quite macro and structural. So what happens to fiscal and monetary policy? Point number 2, very, very important, is what happens to globalization and cross-border trade issues? Where does the US-China dispute go? Which might be, if there's a Trump administration for the next 4 years, we would expect more of the same. But if there's a switch in the administration, then obviously US-China issues might might have a different trajectory than we've had in the last 4 years, with implications downstream to obviously financial services in the fintech landscape. Point number 3, in the big tech space, we've all very keenly been watching what's happening with more supervision and regulatory scrutiny on the big tech companies, particularly obviously the DOJ's lawsuit against Google filed last week, absolutely bombshell event in the market. I thought it was kind of ironic that the day that the DOJ filed the lawsuit against Google, the Google stock went up 4%. I mean, figure that one out. And then, what might happen for diversity and financial inclusion and privacy data protection. On diversity and financial inclusion, last week, the FDIC, you may have seen, or in case you missed it, disclosed numbers on the last available numbers for the percentage of US households that are still unbanked, which means they don't have access to a bank account. And it was terrific to see that at the end of 2019, which is the most recent numbers FDIC released, was the lowest that the percentage of US households were unbanked. It was more like about 5.5%, down from about 8% in about 2017. So that's terrific, like great news that we are almost at a all-time low for the access to banking to American households. That's tremendous. So these are the broad set of factors to look at when it comes to sort of big picture implications of the election on financial services and in fintech. If you look at and please apologize. I apologize for the eye chart here. Don't bother reading the whole thing. You've got access to these slides. But 5 areas that we are looking at in terms of direct implications in the fintech landscape, if there is a switch in the White House or if there's a change in the Senate. Again, prefacing my comments by saying that much of this is going to be a change if there's a change in the White House. If the Trump administration has the mandate for another 4 years, we can expect not a lot of these things to change all that much. So these are really focused around if there's a change in government, then here are the 5 areas we're looking at. So the number one area is the M&A climate for large banks, which has been quite favorable in the last couple of years. We had record M&A activity in 2018-19, particularly in the large financial institution space. We had 3 massive deals in the payment space, you might remember last year. Big consolidation for entrenched players in that space, like WorldPay and Fiserv and a bunch of players in that space. So major M&A activity in 2018 and 19. 2020, Q1 and Q2 were abysmal for M&A. Nothing to do with the government policy, it was more to do with the COVID situation. And we think that if there was a switch administration to a Biden administration, usually a Democratic administration tends to be a lot more tougher for things like antitrust deals. So we expect that if there's a change in the White House, then there'd be a tougher climate and environment and more scrutiny by the DOJ, by the Department of Justice, on large institutional M&A transactions. That would essentially mean that big banks might switch strategy and be more willing to acquire fintechs. So that net might be actually good for the fintech space, for privately held venture capital backed fintech companies. The second thing is that the Biden financial plan, if you read that, one of the big things they've proposed is, and there are not a lot of details available, but they've proposed the creation of a new public credit reporting agency. That would be quite major in the lending space, and that would be a new agency that would compete with Equifax, TransUnion, Experian. The implication for the fintech space is, on the one hand, it might kind of further weaken the lock that the traditional credit bureaus have had on lending in the U.S. But on the flip side, the new credit reporting agency may actually embrace some of the more innovative concepts that a lot of the digital fintech companies have been doing in terms of bringing alternative criteria to bear on making lending decisions. So to the extent that that new public credit reporting agency, starting from scratch, might actually embrace some of the innovative concepts and approaches and alternative data that the fintech companies have, that might actually net end up being negative for privately held fintech companies, which till now have been proposing that go with our alternative lending metrics because we have significant improvement over the traditional FICO-based lending practices followed by the traditional credit bureaus. Third is around fair lending regulations. So the Trump administration rolled back a lot of accommodative policies towards fair lending over the last couple of years. And without offering any kind of political opinion one way or the other around that, that's what the administration did. And we think that if there's a switch in administration to Democratic administration, then we would have a lot of those fair lending restrictions on traditional banks be reimposed. And that would, to some extent, reduce the attractiveness of alternative digital lenders who have filled in the gap left by the large institutions as they have withdrawn from providing a lending ability, particularly to minorities and lower income households. Fourth is on the financial advisory space. You might remember that last year, regulation best interest got passed. And the long story on regulation best interest, which actually governs the restrictions and regulations and the supervisory environment under which financial advisors operate. The long story there was that Obama administration in 2009 had proposed something called the fiduciary standard, which would basically have imposed much more stricter requirements on financial advisors when they are offering advice, wealth management, which stocks to buy, what your portfolio allocations might be. So imposing greater amount of requirements, fiduciary requirements on retail financial advisors. That was the original plan, the fiduciary standard proposed in 2009-10. When it actually got passed, it was a much watered down version of it. And then it got stuck in the usual sort of political rigmarole. Finally, where it happened, where it came out, was a much more watered down version was passed by the Trump administration called Regulation Best Interest. And the impact on the fintech space is going to be, we think that if there's a switch in administration, then we might actually have go back to maybe the old fiduciary standards, so more restrictive regulations on financial advisors. And that we think could be a shot in the arm for robo-advisors and digital wealth managers who have marketed themselves as an alternative to the traditional human-based financial advisor model. And last is in the cryptocurrency space, despite the fact that the SEC, the Federal Reserve, the OCC, all the different regulatory bodies, and obviously the two houses of government have passed some laws, and there's some more clarity around cryptocurrency regulation. By and large, our view is the Trump administration has been quite kind of laissez-faire, hands-off in regulating cryptocurrency. That to some extent has fostered innovation in the cryptocurrency space, but I think it's also slowed down institutional adoption of cryptocurrencies, where institutional investors have felt a little bit held back by a lack of clarity of rules and adequate supervision. If a Biden administration comes on, then there is some indication that some of the cabinet picks that the Biden administration has proposed might be taking a more active and aggressive posture towards cryptocurrency regulation. And that, I think, over long term would be good for the cryptocurrency market, because it would be a more positive environment for big institutions to actually come in and make meaningful allocations to the cryptocurrency space. So those are kind of 5 areas where we think there could be direct implications of the election on fintech. The 6th one that I don't have here is any kind of impact of a switch in administration on open banking, which is obviously a huge focus in this space. That's all around creating an open banking environment where there's more data sharing across big institutions around consumer data particularly. And we might expect some changes in that space as well. So those are 5 sort of very quick areas that we're looking at in terms of direct implications of election on fintech. And like I said, if there's going to be another 4 years of the Trump administration, expect more of the same and few of these things being reflected and manifesting themselves. But if there's a switch in administration, then clearly there might be some changes across these areas. I'll spend another maybe 5 to 6 quick minutes, and then we'll sort of have a discussion with Sarah and Shri on these issues. But one of the things that we look at, we're obviously investment bankers, and we've got a big presence on the floor of the New York Stock Exchange, is changes happening in the capital markets, and a couple of areas where I want to sort of piece together what's happening in different areas and kind of give you the bigger picture. Overall, the bigger picture here is around, you all get it, more automation, more innovation happening in the entire capital raising, companies going public process, right? That's overall the big story. And that's nothing new. That's been a long-term sort of focus for the last, 4 to 5 years. But if you break up what's happening in the capital market space, here are the 4 areas, and I'll sort of walk you through. Let's go, clockwise from the top left. On the public listing side, which means companies going public on the New York Stock Exchange and NASDAQ, the big story there has been beyond, obviously, I'll get to the SPAC issue. But longer term, last 10, 15 years, you might remember that back when Google went public in 2004, through a Dutch auction, which was an alternative to the traditional investment banker-led IPO model, which usually charges between 3 and 5% of the total amount of proceeds of an IPO. The Dutch auction was an alternative to that model. And for a long time, followers of the investment banking space, you might remember a legendary investment banker called Bill Hambrecht, who at Hambrecht and Quest back in 1998 pioneered the concept of the Dutch auction. And there were a couple of companies like Google and Morningstar that went public through the Dutch auction. But by and large, after 2004, for the next 15 years, there weren't a lot of companies that went public using the Dutch auction. Last 4 or 5 years, there's been a resurgence in alternative ways for companies to reach the public market without going through a traditional investment banking-led IPO roadshow model. And the two big changes there have been recently Spotify and Slack, and we also have Airbnb that is projected to go public in the same way. We also had Palantir that went public through a direct listing. So direct listing basically is a way for a company to go out there and raise capital, or actually technically not raise capital, but make their private securities be listed on an exchange without actually having to go through a traditional investment banking route. Now, today, if you use a direct listing route, the SEC doesn't allow you to raise fresh new capital. You can basically take your current private capital that you have, private securities, and make them available to public market investors. But the SEC is in the process of relaxing those restrictions in public listing. And very shortly, in the next 6 to 12 months, we expect, if not sooner, that direct listings would allow companies to also raise fresh new capital. Beyond that, very quickly, the SPAC issue is, despite whatever you've read last 6 to 8 months, SPACs are nothing new. The idea of a special purpose acquisition company vehicle for companies to go public is not new, but last 12 months, obviously, last 6 months in particular, there's been an explosion of SPACs that have gone public. The common theme there has been a marquee, well-known private equity investor like Bill Ackerman that basically is using the brand image and the recognition of the private investor to essentially create a private SPV vehicle, list that on the exchange, and then take the proceeds from that and identify a company they want to acquire and take public through that route. Until now, in the financial services space, we haven't had a lot of big companies that have gone public through SPACs. There is talk about Stripe maybe going public, the largest fintech privately valued at about $36 billion to maybe go public through a SPAC. So that's on public listing side. Top right-hand side, nothing new happening in that space. That's basically private fundraising. We've obviously seen the crowdfunding platforms that began in 2015-16, shot in the arm from the Pension Protection Act that allowed firms to raise capital through alternative means. Nothing new there. We had ICO craze in 2018, then the securities token offering craze of raising capital in 2019. Both of those have dramatically sort of fallen off the cliff this year, in part because the SEC has filed lawsuits against a lot of companies that raise capital through the ICO and STO route. So nothing new there. Moving down, bottom right is what's happening in the M&A landscape. That's quite fascinating. That's something that, we are M&A bankers as well. And what's been happening there has been a lot of the large bulge bracket companies like Goldman and JP Morgan, Merrill Lynch, have actually been rolling out their own applications, their own apps in a way, for big corporates to actually understand which of their businesses is underperforming, and do that analysis, and then be better able to engage with bankers and say, I've got this particular division's underperforming, I want to divest it or want to acquire something. So basically, it's automating the lower end of what traditional M&A bankers did, but handing all those tools to big corporates so they can do that work themselves, and basically automating the lower end of the M&A stack. Bottom left-hand side is a fascinating area. That is the trading of private securities. You might remember 2015, NASDAQ under Bob Greifeld bought a company called Second Markets, Barry Sealbert's company, that today is the largest private market for private securities, called the NASDAQ private market. NASDAQ private market allows private companies like Airbnb or Ant Financial to list their private securities to be traded and sold to accredited investors. There's been some relaxation of the accredited investors definition, so average retail investors increasingly being able to buy shares in private companies on these markets. Beyond NASDAQ private market, there are a slew of other providers in that space. I've listed 5 to watch right now. There are about another 3 that we don't have on this list. Watch that space very closely, because that's an area where it allows both retail investors and a wider set of institutional investors to essentially buy private securities. Again, something that was not possible literally about 3 or 4 years ago. So across capital markets, bringing it all together, whether it's private fundraising, the trading of private securities, unconventional ways for private companies to go public through direct listings, Dutch auctions, or SPACs. And then what's happening on the M&A side, there's been major movement around the capital market space. Moving into very quickly what's happening in this space in terms of the fintech space, breaking it up across 6 different segments. I'll spend about 2 minutes here overall, and then we'll sort of hand it over and have a conversation around this space. But we've essentially used an income statement framework to look at what the implications are for the COVID situation right now over the last 6 to 8 months on 6 different sectors within financial services. So the way we've kind of looked at challenger banks, for example, is say, let's think about how challenger banks make money, net interest margins, right? Let's think about what the big expense structure is. The biggest expense structure for challenger banks has been customer acquisition costs. And over the COVID situation, one thing that happened was investors became a lot more skeptical, a lot more circumspect, a lot more risk adverse, and saying, I'm not going to keep providing money to challenger banks to go out there and take investor money to go out there and acquire customers. You'd have to have an organic way of raising awareness, marketing yourself, and acquiring customers. So suddenly, if you look at the expense level on the challenger bank space, they had to look for other ways to go out there and acquire customers. So customer acquisition costs for challenger banks suddenly have shot up last 6 to 8 months. Those expenses have directly fallen down to the revenue bottom line, and profitability for a lot of the challenger banks has actually suffered. Now, overall, I will say that from where we were back in the spring when we were expecting dire situation for private fintech, it's actually been quite good. Q3 of this year has been one of the record quarters for M&A in the private fintech space. So things have recovered pretty handsomely. But I think I'll tell you as a second-tier investment bank, we sort of play in the mid-market space. A lot of the M&A activity and the private fundraising that you see is happening very much focused around late-stage companies. There's been investors that are doubling down on late-stage companies. You've seen massive increases in valuation for unicorns like Robinhood, Coinbase, take your pick, right? Stripe, Chime, Revolut. Take Robinhood, for example, in December of last year, 2019, Robinhood was $3.5 billion in valuation. In February of this year, they did a round of capital. They were valued at $5.6 billion. Today, they're valued at $14 billion. Right? So massive uptick in valuation, but like I said, across fintech, both fundraising, valuations have been very, very much focused around late-stage companies, unicorns, and what is happening on the smaller end. So whether it's seed stage activity or mid-market, so companies that are in the valuation of between $20 and $100 million, though they're actually suffering quite a bit. So across the board, yes, I'm saying as a banker, things are not as bad as they were back in March, April, but it's very much focused around late-stage companies. Beyond that, let's just take all the 6 areas and just quickly give you 30 seconds what's happening. Challenger banks, top 10 challenger banks have done extremely well, but there's a major shakeout happening in everyone below the top 10 challenger bank area. Now, we obviously hear about the new banks and the Revoluts and the Chimes and the Varos. The other big story in the challenger bank space that you've probably been watching is, and this is actually a broader theme across fintech, is that a lot of the fintechs till now were focused really around distributing financial products out to the market, particularly in the consumer space. Last 6 to 12 months, we are actually seeing a lot of the fintechs that are actually going out there and acquiring banking licenses, payment licenses, insurance licenses. So moving upstream from not just distributing financial product, but taking principal risk. So Revolut, Chime, Varo are 3 examples of companies, challenger banks, last 6 to 12 months that have now banking licenses in the US, which means they can take deposits, get FDIC insurance and deposits, and actually start competing directly with banks head on. So that's been a big change in the challenger bank space and across the board in financial services. Another example of that trend is happening in insurance very quickly. You had Root that went public last week. We had Lemonade that went public 5-6 months ago. both Root and Lemonade are licensed insurance carriers. They just don't distribute financial product out to the marketplace. They actually are registered, licensed insurance carriers. That's a major change compared to the first crop of insurtechs and fintechs that grew over the last 6 to 8 years that did not have banking licenses, didn't want banking licenses. They were essentially only distributing financial product. On the digital lending space, basically the bottom has fallen out there, right? Both in the public market and the digital lending space, with firms like OnDeck, that was a darling on Wall Street 5 years ago. Now, at one point they were valued at about 2.5 billion. As of this summer, they were valued at $90 million, and they sold out to a company called Innova. So the digital lending space, big pressure to be expected because in a economic downturn, foreclosures go up. While interest rates come down, there's still a lot of foreclosures, a lot of defaults, a lot of delinquencies. That tends to impact the digital lending space quite significantly. So that's happened in the digital lending space. It's a very cyclical space to be expected. Under downturn, digital lending takes the hit on the chin. The robo-advisor space, we had obviously a big player in this market exit quite early, a company called Motif, you might remember, run by a great CEO called Hardeep Walia. They had a tremendous roster of advisors from Arthur Levitt to Sally Krawcheck, and they just closed shop back in April, May, which was, we thought it might be a canary in the coal mine and would show more pressure in the robo-advisory space, but the robo-advisory space has actually done pretty okay. But I think a lot of the massive valuation upticks we saw in 2017 to 19, the robo-advisor space have sort of slowed down pretty significantly. So we haven't had massive capital raises in the robo-advisor space for quite a while. Capital markets has always been a feast or famine business. And fortunately for firms like ours in the public market space, transaction volume has been massive because of volatility. So we've actually benefited from massive transaction volume in the institutional capital market space. Beyond that, from a fintech standpoint, institutional capital markets is a tough area, as Sarah can attest to, for fintechs to kind of break in. High barriers to entry, massive regulatory capital required. You need tremendous amount of scale to participate in that space. So capital markets, institutional capital markets, is a lot of activity in the large company space, but fewer amount of opportunities for fintechs to actually make major inroads in the capital market space. One area that we are seeing capital markets do quite well is companies like DVO1 shedding light to places like the ABS and the MBS market. A company called Capitalists, which is a venture capital funded company that is trying to improve collateral management. So there are pockets in the capital market space where fintechs are doing quite well. But by and large, that's not a space where a lot of the venture capital funded, privately held companies are making a big dent. Payments, massive growth in the payment space in around embedded payments. Beyond that, obviously, there's been overall, because of the lockdown and the COVID situation, transaction volumes in the payment space have come down. But obviously, digital payments have gone up a lot. The biggest benefactor of that has obviously been Square. I'm kicking myself that I didn't buy the Square stock earlier, but that stock has exploded. Big story there in Square has been they have moved over the last 2-3 years beyond the Square Cash and the Square Dongle that we all remember them from 4 or 5 years ago. Square actually applied for a banking license, got that in March, April, and they've got the Square Bank with a banking license. They're providing Square Lending, Square Cash, essentially using the Square platform and the knowledge they have around merchants in the platform, and now offering lending products and credit products just like a traditional bank is, with better amount of insight on cash flows for all the merchants that are on the Square platform. So big story in payments is Square, and then increasingly the embedding of payments in non-financial companies and the provision of payments through vertically oriented software companies. That's a trend that we're seeing across the board, and everybody is investing in that area. In insurance, on the last part, like I said, the big story there is a lot of the fintech companies like Lemonade, Root, and others, Hippo, that are increasingly becoming insurance carriers. Of the 10 fintech companies that went public in the US, 6 have been insurance companies. So there's been larger number of insurtechs than in the last couple of years that are going public. So very quickly, that's kind of what we're seeing across 6 areas. Happy to delve deeper into any of these areas in a Q&A or the discussion with Shri and Sarah. So Shri, let me hand it over back to you, and spend the next 20 minutes in having a discussion around these areas. So let me stop sharing my screen. Let me back here.
Awesome. This was awesome, D. I can't believe we just had like 30 minutes, and it was probably like 6 hours worth of lecture packed in like 30 minutes. So thank you for providing your insights. I know it takes quite a bit of time to kind of keep your ear to the ground and hear about all the things which are happening. When you take, I'll let you take a quick breath before I can ask you some questions. So Sarah, I just wanted to start off this conversation by asking about some of the fintech innovations which are happening in the Massachusetts area. I know you were involved with a recent report by the E&Y about like the fintech ecosystem in Massachusetts, and there was also a summary version of which I saw, which said like fintech is at the crossroads. So I wanted to see if you had any specific thoughts about where the industries are going, what kind of digital trails you're seeing in terms of the success stories, and also the ones which are trying to be successful, and how do you see the ecosystem acknowledging all these things and fortifying the whole aspect.
Yeah, Shri, thank you. And Dee, I agree with Shri. What a tremendous amount of information you just shared with us on trends, and also the extrapolation out of forecasting in a period of crisis that we find ourselves. And Shri, let me address the report on the Massachusetts FinTech community, and then kind of lift it up to a more global perspective that I hope, Dee, you'll engage in, because I do think that we have, as you opened up your comment, Shri, benefited from a number of individuals in the local community in Massachusetts, yourself being one, Dee, as you were at MIT and otherwise, to help us really build this robust collegial environment where fintech entrepreneurs are lifted up, where you have this desire to create intersections, not only with customers, but with investors and with thought leaders. Dee and Shri, I count you all in that category, which helps our local entrepreneurial community pivot. And one of the areas that, Dee, I was so struck by as you were saying it, is that the influence that the pandemic has had on payments in particular, and the winners like a Square. And I couldn't help but intersect that in my mind, because we too have this very thriving payments community. Excuse me. I don't have COVID, by the way. I just swallowed, too bad. But this intersection of payment entrepreneurs. We have a couple unicorns sitting in Boston with the increase in, if you will, underserved individuals who, or decrease, I guess, in the individuals who are underserved. You mentioned a 300 basis point improvement of individuals who have historically not been served by the banks, and as reported by the FDIC. And what I'm seeing is, and I think the numbers play it out in the entrepreneurial community, is such a rapid increase, just as people are being banked, turning away from the banks, if you will, as a payment vehicle, and using those systems. And to your point, using Square, or perhaps more increasingly Venmo, maybe PayPal, to create these peer-to-peer payment environments. And I'm just really, for myself, I think it's a very curious moment in time, and perhaps you have some thoughts on where the entrepreneurs in the payment space, which is one of those great areas in the Massachusetts communities, might find themselves with the next opportunity. Do we see this continuation post-pandemic of digital payments, moving away from traditional banking providers to actually enabling that exchange and flow of funds? It's one question I think that I have outstanding of a number that came to me as you were talking. But Shri, you're the moderator.
Well, I'd love to just sit back and listen to you guys. I'm just making notes so that I can teach my students when I go back to my classroom.
But isn't it it's a wonderful intersection? And then if there's a tertiary and perhaps non-secular trend, but something that we're observing, of course, is the really incredible contraction in consumer spending. So we're taking money off the table. We all can probably think about the implications for fintech and entrepreneurs in an environment where payments are changing rapidly, how we conduct them, what it means when there's less spending in the marketplace. I think you mentioned that, Dee. What it eventually means to the downstream implication of how we innovate around lending and credit. And then, of course, the big white whale for me, and Dee, the comment you made is, are we as an entrepreneurial community disintermediating capital markets from the back door? So I think there's three big themes there for us to unpack, Shri, as we talk about the implications of COVID on fintech, if I picked up on what Dee shared with us.
Yeah. No, I think, Sarah, great points that, again, we see a dichotomy, or a tale of two cities in every part of the industry. You look at the stock market, you look at the S&P 500. I mean, you talk about the stock market's reaction right now at the start of our conversation today. We don't know who's the president, and the market's up 750 points. I mean, try to figure that one out, right? But contrast that with how the average company, the Russell 2000, is doing. We know that story, right? I live in Winchester. Stock market's doing great. You do go down the street, 2 dry cleaners have closed. I had a shoe repair guy. I stopped by there and says, I've just started opening up my shop now 1 day a week. So the contrast between how big companies are doing and the mom and pop businesses on the street are doing, there's a massive, distinction there. And I think that is reflected to some extent in the fintech space, that the large unicorns, right, the large Robin Hoods, like I said, are still doing well, but I can see it every day in the calls that we get from the smaller fintech companies looking for capital. We all hear in the Wall Street Journal or Bloomberg or whatever, or CB Insights, the big capital raises. But if you look at the breadth of companies that are raising capital, it is definitely a much tougher environment for them to raise capital. And we can see that because we get more calls from those companies now asking our help to raise capital, where 6 to 8 months ago, there were 5 VCs falling over themselves to invest in that company. So I think that's one point. Now we're not economists, so we haven't sort of figured that one out, that how contraction in the consumer economy is going to impact the fintechs downstream. But we can see some reflection of that. I think the other thing is, and this was actually predates COVID, while the first wave of fintech growth of the last 6 to 8 years was very much focused around consumer-oriented models, as Sarah, I'm sure you've seen it yourself in your experience, there's been a lot of focus around the B2B space, right? So more business-to-business oriented fintech opportunities. There's been a major amount of growth in that space. That might continue to actually or accelerate. And we're seeing a lot of the investors, the big VCs, are switching that direction anyway, coming out of the COVID situation, that we expect, even though consumer credit might come back, consumer spending might come back, it's not going to be where it was in February of 2020 for another 2 years. And therefore, if you're an investor trying to put fresh capital to work, I think they are more hesitant in putting it to more B2C oriented companies and more B2B oriented companies. So those are sort of a couple of quick points. On the payment space, very quickly, I would say that again, it's a mixed bag. If you look at the overall amount of transaction volume through the big networks, right, whether it's MasterCard and Visa, they are down almost about 22%, even after resurgence after Labor Day. So summer was 40 to 50% below the same time last year. After Labor Day, we had a big uptick. The market opened, consumer sentiment increased, there was more spending happening, some travel improved, but we are still about 18 to 20% below for the large networks, Visa, MasterCard, and all those guys. Having said that, to your point, PayPal, Venmo, all the unconventional, if I can call them unconventional, ways of sending payments, money remittances, and all of that, that's been actually doing quite well. Having said that, listeners probably saw that yesterday, Zelle, the big consortium, announced the record growth, right? So the big banks are fighting back. And I think the gap between the traditional incumbent institution and the fintech company, if it was 10 percentage points 24 months ago, I think it's about 7 percentage points now, right? And I think some of the tougher economic environment for everyone, to some extent, might actually end up hurting the fintechs a little bit more and might actually position the large banks, big institutions to actually gain a couple of points over the fintech companies. I was actually, as a banker, expecting more amount of acquisitions being led by big institutions of fintech companies that are opportunistically picking up assets, but hasn't happened until now. Maybe it'll happen in the next 6 to 12 months. So I think the payment space, it's again a mixed picture there. Reduction of overall amount of transaction volume, more transaction volume going towards digital upstarts like the PayPal and the Venmo guys, but contrast that a little bit with the resurgence of activity in people like, consortiums like Zelle that have actually picked up a lot compared to where things were about 2-3 years ago, where there was a wide gap between sending money through a Bank of America account versus what you could do with PayPal.
So let's just kind of delve a little bit deeper into the whole spending aspect, right? So, I mean, consumer spending has significantly gone down, especially when it comes down to the mom and pop examples we were kind of talking about, foot traffic into the retail establishments, and how people are actually saving more. I mean, we have had like record savings. Everybody's talking about, well, my saving rate has gone up so much, considering all the opportunities I'm missing, deliberately missing, right? On how does that kind of, from a driver perspective, you're considering spending as a driver for many of these fintechs because they're transaction oriented. The transaction volume fuels the growth of customer acquisition and kind of fueling that whole machinery, right? But on the other hand, on the enterprise side of things, just because we have to now think about moving to the cloud, there has been significant spending in terms of infrastructure and also technology-related spending to move assets to the cloud, moving data and compute assets to the cloud, and that's why we're seeing record numbers and the cloud vendors and all the spending which is going on there. How do you kind of see the fintech ecosystem play out? Are more and more startups going to be focusing more on catering towards like the incumbents, as you call them, and saying like, here are some products which could potentially help your ecosystem? Or do you think once the spending starts coming back as we post-COVID see the things come back, you're going to see a resurgence in business models or picking up of some of the the tours of the world, if you will, which had to basically shut down half their operations because no one was going to a restaurant, and now things are coming back. So will the expansion start happening there?
I mean, I think if you look at sort of consumer spending, first of all, I mean, just you don't have to be super smart to understand that in our economy that depends, 72% of consumer spending. If consumer spending is down 25% compared to last year, obviously it's going to impact, the economic situation at some point, right? Beyond that, I think you can't really tease out. It's consumer spending is kind of at a more macro level, right? And you're talking about the fintech implications at this level. So I think any implication on fintech is kind of 2 levels below. It's a very indirect kind of impact. In terms of one area where you might see an impact is, Shri, your question, that is that going to push a lot of the fintechs away from the consumer space. That was anyway happening, as I said, in the last couple of years, right? It was a natural evolution that a lot of the fintech companies and a lot of the venture capital money was focused on the consumer market, right? And particularly in retail banking, in payments, in robo-advice. Anyway, even before COVID, taking that out, we were moving in the direction of more B2B oriented, investments. And I think that might continue to sort of accelerate that trend. I don't think the market's big enough to accommodate, I think I remember in January of this year, we did some analysis for all challenger banks that had more than 1 million accounts. And there are about 28, 30 challenger banks around the world that had more than 1 million accounts. And now there are barely about 12, right? So I think there's been a contraction sorting out, the fringe players across fintech have actually are not doing all that great, which I think might be, good for the market overall, for the fintech marketplace, because you don't need, 100 challenger banks. You might need 10 or 15 really good ones. I mean, take your pick. In every part of financial services or fintech and insurtech ecosystem, there've been a lot of marginal players that have gotten funded, and that net is bad overall for the market, right? You don't want, substandard companies to be funded. So I think some of that shakeout is beginning to happen because of COVID, but the movement away from consumer-oriented fintech models to B2B-oriented models was, I would say, actually already happening and probably gets accelerated with the COVID situation.
Yes.
So,
So are you kind of seeing similar things, in the startups which are kind of approaching the sandbox and other, your kind of how are things progressing in terms of people seeking money or seeking business models or thinking about the ecosystem?
Yeah, Shri, I wanted to pick up on something, a really important secular trend that you just slipped in there in the question of consumer spending, and that was the acceleration of the institutions moving to the cloud and the movement of data. And frankly, I mean, you said assets. I thought data, right, just with our work in the FinTech sandbox. But critically important systems are rapidly being digitized. Where we had previously seen a hurdle. I mean, I started my last company in the wake of the credit crisis. As Dee referenced, it was a capital markets bond investment platform, bond investor platform. And I thought at the moment then, and I just couldn't reflect with what you just said, Shri, now, never let a good crisis go to waste. And I don't want anyone to think that I'm sounding crass or not reflective of the pain that many of us have gone through this current pandemic. But the reality is that we have seen a push towards digitization that otherwise may not have been catalyzed as quickly. And so what I see both in terms of investing today in the entrepreneurs and the fintechs, supporting them through the FinTech sandbox, working in the community, is that we are at a pivotal moment where we actually do have the opportunity to utilize this new intersection of institutional investment in the cloud, in new environments, to actually advance the adoption of innovation. And Shri, you and I ought to talk about this in 3 years. Better serve the consumer on the street, better serve the small business, because we now have that important intersection of technology, long reach, but also the emergence of new models and data that lets us make better decisions in the absence of right now. To be honest, what's a credit model going to look like for that dry cleaner, Dee, that you just talked about, right? We have to develop and we have to create new sets of observations that let us more intelligently lend based on a period that's unprecedented in any other time. And so I think we're at this really unique moment. If you're a fintech entrepreneur, now is your time. Yeah. You have to ask yourself the question, what will I do with this time? And that's what I just took away. I mean, I'm forever the optimist, right? But in all honesty, it is a really great moment to be a fintech entrepreneur. Absolutely. And to think about solving some very seemingly intractable problems. And Dee, your point is well made, though. Does the capital flow to those individuals who are uniquely positioned to solve it? Or is it flowing, as you've just correctly said, to larger deal sizes, but smaller numbers of entrepreneurs? And that, to me, is probably the question that needs to be asked. Yeah. There's many questions, but that's just one of them. And so how do we see the redistribution of capital against really good ideas in a period of uncertainty? But I think I danced away from your question, Shri, to pick up on.
But I think
I thought was really important, that intersects with what Dee has taught us today and what you asked.
Absolutely. So I have another question which is coming from the chat window. So Rod asks, like, traditionally B2B opportunities have been a hard slog for large institutions preferring to do their own thing instead of leveraging or partnering or buying fintech startups. Is that where the action will be for the next 2 years, or are there specific areas that should be focus areas for fintech startups? On the consumer space, is there a way to do good and still be able to grow into a large fintech company? Very thoughtful questions. I'll take both of you, both of you, what do you think about it?
Sarah, why don't you take a crack at it first?
Well, Dee, since it was asked by one of our dear friends, Rod Sarah, I feel like we're talking to directly over coffee. It just removed all this virtual stuff we're in. So, Rod, thank you for that question. I think we learned, Shri, to go back to just your pointed question about the study of fintech, the working group of institutions, investors, entrepreneurs, and academics have come together with EY to produce in Massachusetts, is that we see that this emergence of this shift, it's been 5 years in the making, but of institutions opening their doors and seeking now a different type of partnership. And so I think the old way that we fought so hard against, right? We fought the old for a long time, which is to get into the institution. I think now the new paradigm, and certainly moving forward, is an easier transition moment with the institutions. And I don't have any other proof, but the sense that I'm sitting at the table with the largest financial institutions in the Boston area right now, thinking about those thoughts and how do we improve it. But I'll go back to that question I asked Dee, because it actually excited me. Are we tackling these institutional challenges by disintermediating in the form of direct listings, in the forms of SPACs, in the adoption of new and different ways to fractionalize securities? So you're no longer seeing this closed loop environment in the capital markets. That change is being pioneered by the innovators. It's not the institutions who are opening their doors. And it might be, Shri, your question might be best answered now by you, Dee. Are we at that moment when the institutions actually are cooperative, but we also maybe see a displacement, but not in the negative, but in the positive, because it makes the capital markets more accessible?
Yeah. No, absolutely, Sarah. And Shri, I'm going to answer that very quickly, and I got to run because I've got something at 1 o'clock. I'm sorry. But Rod, thank you for your question. I mean, that's, nothing new there, right? I mean, trying to move anything to B2B space has traditionally been a longer process. And that's the reason why a lot of the early investors were hesitant in putting money to work in the B2B space. A lot of entrepreneurs were more keen to start business in the B2C market because it's much easier to acquire customers in that space. So there's nothing new there. I think I will say that big institutions are a little bit more open to seeking help from fintech companies on conventional places to actually address problems. We're seeing that happening in corporate banking. We're seeing that happening in parts, like I said, in the capital market space, collateral management. So there are pockets of the area where pockets of the financial services industry where B2B models are, big institutions are a little bit more open to looking for smaller companies to actually provide ways that they can tackle issues. In the capital market space for the trading of private securities, for example, right? NASDAQ Private Markets, like I said, began trading private securities, but the other 6 players that I had on my chart are all small venture capital funded fintech companies, like Equidesign and Adipar, which has been around for a while, but they're all basically, like I said, 50, 75, 100-person companies that are trying to tackle a major issue, which is bringing liquidity to private securities. So I think there is, no silver bullet, no big change necessarily. It's been overall more accommodative environment for B2B opportunities and fintech companies to play a role there. Nothing major is going to change overnight in that area, but I think overall it tends to be moving the right direction.
So, yeah, thank you. On that note, I think we should start wrapping up. And thank you so much again, Dee and Sarah, for spending your afternoon with us and educating our audience with your amazing research and thoughts. I just want to add one thing, which I tell my students. When we talk about like a smooth flowing process and you think about optimizing this process, you always think of where are these inefficiencies and can address this. And 3 years ago, when I started teaching fintech, that was where the focus was. So you have these rigid pipelines, and the fintechs would come in and say, you know what, I see inefficiency there. How do I grab that opportunity and then kind of create something new? I'm kind of seeing COVID as a forest fire because it hasn't left anybody untouched. That's kind of basically taken everybody to another level, and you have to start thinking from scratch about like what would evolve. Where are those green shoots which are going to come up and evolve from there, rather than just kind of looking at these minuscule opportunities for process improvements or doing things which people have been doing forever, but looking for opportunities. I would love to continue this conversation, but unfortunately we'll have to wrap up. I'd love to have you back on this forum another time, probably in the next few months sometime, and then we'll continue the conversation there. And viewers, thank you for joining us again. And next week, we're going to talk about a different topic on ethics in AI in financial markets. And this time we will have someone from Singapore who's going to be talking about the ecosystem in the Southeast Asia. And they've been doing a lot of innovative aspects in the fintech area. We didn't really get a chance to go global in the discussion today, but we'll hear about from Dan Libu, who is the author of the book the AI book, and talk about what's the ecosystem looking like there in Singapore, and how does the pandemic and other associated activities kind of turning the whole system there. And we'll continue the discussion next week. Thank you again, and I'll see you in the next week. Thanks again, Sarah.
Thank you, Sarah.
It was a pleasure. Thank you. Bye-bye.